Gary typically ends with a trivia question.
Yes.
But this week I'm going to end with a trivia question. How old do you have to be to do an FHA reverse mortgage?
62?
Very good. All right.
All right, I got it. I don't want anybody to think that you need to switch off now because you're not 62 or 65 or 70 or 75. Everybody needs to know about reverse mortgages, because what if your parents are 62 or 65 or 75 or 85? So you need to be able to have a conversation with them about their future. So I'm hoping everybody will listen in. And Laurie, will you start by telling us, what a reverse mortgage is?
Sure. And I'm going to actually give a little preface here. So the crowd older than age 60 is the fastest growing demographic in the U.S. And in just another few years, we're going to hit the tipping point where there are more people over the age of 60 than there are under the age of 30. So it's really a significant thing to know about. And then one other thing I'm going to mention is recently I was at a senior law day for the community, and one of the speakers said, you can finance a home, you can finance a car, you can finance college, but you can't finance retirement. And that really struck me, because financing retirement is really what reverse mortgage is about. So usually when we think of reverse mortgage, we think of refinancing a home you're already in. But let's take it out of the realm of a reverse mortgage and just talk about a mortgage. If you were to sit down with a traditional loan officer from Atlantic Coast Mortgage, you'd be talking about one of two umbrellas. You'd be talking about either refinancing the home you're already living in, this is an umbrella, or you'd be talking about purchasing a new home. Two different umbrellas: refinance loan, purchase loan. Mm-hmm. And we're going to talk about each of those. Now, when it comes to reverse mortgage, most of us are more familiar with the umbrella of refinance. And I'm going to illustrate it using this jar. I call it my pickle jar, because when I was growing up, my grandmother had a pickle jar filled up with pennies. So we're going to let this represent the homeowner's home. And I'm going to dub the homeowner Mom in this case. Now, how did Mom's home get filled up with pennies? Well, one of two ways. She either paid off the mortgage on the home, she and Dad did, or they bought in cash many years ago. And so she's got all this equity, in some cases hundreds of thousands or even millions of dollars worth of equity, but she can't do anything with it.
Just looked at a home in North Arlington, was purchased in 1987 for $165,000.
Yep.
It is now valued at $1.1 million.
Very typical for
to
this.
To say that they're sitting
Great
there,
example.
They may not be cash rich. That is, the monthly cash flow may not be that strong, but they're sitting on $1 million.
So that's the classic house rich, cash poor. And for a lot of our life, it doesn't really matter. We're still working. We can up our monthly income. But in the retirement years, a lot of financial advisors will talk about an unsustainable drawdown, where Mom and Dad have been drawing down their investments faster than that magic 4% rule, and they're drawing it down faster than it can replenish itself through appreciation. And,
especially when you're looking at 7, 8, 9% inflation.
And when
even
we're
if
looking
it just lasts for a year
at
or two.
Uncertain markets. Yes, so vagaries in the market can really impact people who are living on a fixed income, drawing from their investments. So and the reason I'm referring to it as Mom is just the way God's made the world is typically as women, we outlive our men. So we're going to, for the purposes of this illustration, we're going to say Dad's passed away, Mom needs in-home health care or just needs to augment her monthly income, because when Dad died, in many cases, Dad's income also went away with him. Now Mom is living with all the bills and half the income. So a reverse mortgage simply does this. And if you remember nothing else about a reverse mortgage refinance, remember this: it's a home equity line of credit. Mom is allowed to or enabled to reach into that pickle jar and take out some of those pennies as needs arise. Now, never can she pick up the pickle jar and dump out all the pennies. There always must remain an equity buffer in the bottom of that pickle jar, and the size of that buffer, or the amount of that buffer, is determined by her date of birth. The older she is at the time of origination, the more pennies she can access. If she's very young, if she's right at 62, she's going to have access right now for she's going to have access to about 45%. If she, on the other hand, were 82 or 92, she's going to have access to, upwards to 75, exactly. Now, this should sound exactly like a home equity line of credit, because it is. So why not just use a home equity line of credit? That's a common, it should be a common question. Well, the reason is this: if this were just a traditional home equity line of credit, and mom reaches in, let's say she needs $20,000 a month for in-home care, so she takes out that money, and she is undeniably in a better position for 29 days. But on day 30, now she's got a mortgage payment, and she was already cash flow strapped because she's paying so much for in-home care. And then the more she draws, the bigger her month-end repayment obligation gets. With a reverse mortgage line of credit, she has access to that equity, but there's no month-end repayment obligation. The loan is repaid on the back end in reverse.
If she wanted to, she could. Is that correct?
Absolutely.
But she does not have to.
That's exactly right. So if she wants to take that out, and then let's say she comes into a windfall, a rich uncle dies, she can take money and put it back into that pickle jar and re-access it later if she has cash flow needs. So yes, great question on that.
Now let me ask you this. I'm going to just pause right here, because there is a significant, I think, number of people, especially older people, who maybe remember when reverse mortgages started. And we've heard a lot of horror stories. Now, you have to remember how stories work, right? This happened, and then you tell somebody, and now it's like this, and now it's like that. So some of those were exaggerations, but some of them were true. And as a result, the federal government, am I correct on that, has stepped in and laid down some safeguards. Can we talk about that history and what some of those safeguards are before we get much deeper?
Yes, so I love this topic. First of all, the old reverse mortgages, we're talking about in the 60s, even all the way up to the early 70s, they had a bad reputation because they had worked hard to get a bad reputation. It was a bad product. In some cases, it was a predatory product. Most of the bad stories you hear date all the way back to the 60s and 70s. There's no kind way to say that. It was just a bad product, and as I say, in some cases, a predatory product. Nobody heard anything about reverse mortgages for many, many years, and then in the late 80s, under the Reagan administration, they actually started looking forward to this very day when baby boomers en masse would start pouring into retirement. And of course, the question quickly becomes, if these people fall out of the housing market and have to matriculate their way down the economic scale into some godforsaken Medicaid bed, well, who pays for the Medicaid bed?
The taxpayer.
The taxpayer, exactly. That's not where mom and dad want to be. The taxpayer picks up the tab. If mom and dad could have stayed in their own home and aged in place, everybody wins. It's where they want to be. It's better for the taxpayer, and it's certainly better for the federal government. So some people actually went to prison for reverse mortgage schemes back in the 60s and 70s once the feds caught up with them, sent them to the pokey. In the 80s, late 80s, they came back with the federal government under FHA, resurrected the idea, but it's a very different product. And in my opinion, they should have given it a completely different name at that point and not let it be called a reverse mortgage. But remember, the name reverse mortgage, everything's right there in the name. It's a mortgage, but it's paid on the back end in reverse. And now there's much better oversights, many more protections. A huge percentage of reverse mortgages are audited by the state or by the feds.
So if Janie and Johnny, two children, come to you and say, hey, my mom's got a lot of equity in her house, and we need a reverse mortgage, give me the paperwork, I'll take it to her to sign and bring it back to you. That's not going to work.
So it can work that. There's no prohibition against doing that. However, I would strongly encourage the kids, look, let's all get together. You and Johnny will go over to mom's house. Let's walk through, let me tell you what you're signing. There's also a required phone counseling session where the phone counselor, it's a federal requirement, the phone counselor will walk mom through the numbers, prepare a little monthly budget for her, and make sure that there's no hanky-panky going on, that mom understands and there's no bad guy trying to steal title to mom's home or try to steal mom's equity.
Yeah.
And that's a federal protection as well. But the third thing I was going to say, as far as how the product has changed, back when I started many, many years ago, my oldest clients could access almost 90% of the equity in their home, and they could take it in a lump sum at closing. Ooh. So now, several years ago, they cut down how many pennies mom can take out of the pickle jar. And they also break it into 2 installments. She can access 60% in year 1, and then on the anniversary of closing, she can access the other 40%. So they've put in many safeguards, even since it started in the late 80s. All right, I wanted to address real quickly the other umbrella. So this whole time we've been talking about the refinance, but what about somebody who wants to buy a home using a reverse mortgage?
You can buy a home using reverse mortgage. Tell me about that.
Exactly. So Gary, you've already sold their exit property, the home they've been living in. That's been sold. They've taken all that money, they've put it in the bank. Now you find for them the perfect home. They just have their heart set on this home. Here's how it will work. And let's, for argument's sake, say the house is $800,000. And if mom and dad are 75 years old, they're going to bring a down payment, the size of which is determined by their age. At 75, they're going to bring about 50% of the purchase price to the table. The loan amount is going to make up the rest. No big duh here. Down payment plus loan amount makes up the purchase price of the home. But they're done. They've made the only payment on that home.
They don't have to make a monthly.
They don't have a monthly mortgage payment. When the last person on title dies, typically the kids, the heirs to the home, will sell the home. The loan will be repaid on the back end in reverse. The kids will get the rest of the equity, including any appreciated value of the home.
That is something that everyone needs to know about.
Yes, yes. And one of the biggest things I see is mom and dad are afraid dad's going to pass away, mom's going to have a traditional mortgage on the home and not be able to meet that monthly mortgage payment.
So you could downsize and be mortgage free for the rest of your life.
Not mortgage.
I'm sorry, payment plea.
Exactly.
That's the difference.
Not
You could
have
be
a monthly.
payment-free.
That's exactly right. That is exactly right.
Wow. That is awesome. We didn't talk about this part before. I'm just going to throw this out at you. Mom wants to move into a congregate care facility.
Okay.
The house isn't ready to go on the market. There needs to be some work, but she needs to come up with $400,000
As a buy-in.
as a buy-in in the next 30 days.
Okay. All right.
Could she use a reverse mortgage for that?
She could. Let me tell you some reasons why it's not a great idea. So first of all, you've got closing costs, and if it's going to be short term. Now I'm going to actually preface this even before I say it's not a great idea. If that's what she has to do, that's what she has to do. $400,000, that would be tough to extract that much in year 1. It's not impossible. If mom were very, very old, she might be able to get $400,000. There's also a jumbo product where she could certainly extract $400,000. But the reason I'm not crazy about this idea is because once mom has moved out of the house full time, the clock starts ticking as far as getting the house sold or at least getting the loan repaid. So the kids have got 6 months, and depending on how much remediation the home needs, and she's taken all that equity, used that as a buy-in. Now, like I said, I have had people who've had to do that. If mom's had a stroke and the kids simply can't care for her at home, no amount of in-home care is going to get her the amount of care she needs. You do what you have to do to care for your loved one in that last chapter of life.
So while it may not be ideal,
yes, the concept
in an
works.
emergency, and I just picked a big number, 400.
Okay,
I mean, it could be 200, 250, but
you do introduce a different topic that I want to address ever so briefly, and we can't go into too much detail here because it's a little bit complex. But whatever you haven't touched that's sitting in the home in the line of credit is actually collecting a reverse mortgage growth rate. And right now it's growing at just about 8%, a little tiny bit over 8%, like 8.1% as of today, this mortgage, this money's number, this morning's numbers. So think of, I'm going to take away from the pickle jar here and imagine the line of credit like a big lump of bread dough sitting on the table. that is growing. And when mom needs to use it, she can pinch off some of that, use that to meet needs, and whatever's left there continues to grow apace. So if mom were to originate early, let's say she's 85 and she knows that in another year or a couple years she's going to want to do this, she's going to want to take everything and use that for a buy-in to a continuing care retirement community called CCRCs. She can take out not just what she qualified for at closing, but now that appreciated asset where it's gone up in value, not because the home's gone up in value, it'll go up even if the home goes down in value. It's part of the program, part of the product that the reverse mortgage line of credit is collecting that growth.
So you could take it out knowing this is what I want to do a year from now. You go ahead and do your paperwork now, and that gives you a little, you don't have to take money out at settlement.
Exactly. That's
you use it for planning.
Exactly right. And I've had, well, no, I was going to say I've had many people do it. I've had a number of people do this over the years where they're doing it simply as advanced planning, where they're originating now, waiting for it to grow, and then they're going to take the whole amount and use it to buy into one of these.
Can we go back to that other example for a moment? Sure. Say mom and dad are living in the house. Mom's had a stroke. Well, dad usually has the stroke. Dad needs to go into some form of congregate care living. Yes. You need a lump sum to get them in. But mom is not ready to go yet, but they need to get him in there for the care. Mom may move in next year. We just need to settle everything down.
Yes,
yes. Would that be a situation then where?
Absolutely, absolutely. As a matter of fact, that is a very common scenario. And I'm going to call the parents different things. So there's the parent, so dad is the community, or the residential spouse. So he's in a residential home. Mom's a community spouse. She's still out there in the home in the community. And it's costing $25,000 a month to keep dad in the residence. So where does mom derive it? Well, of course, first she goes for the investments, money in the bank, whatever kind of liquid assets she has, and then she's within $25,000 1 month of running out of money. So then usually it's the adult child who calls me and says, my mom and dad are really having a hard time. Dad's deep into an Alzheimer's diagnosis. Mom is running out of money. I can float her for a couple months, but I've got kids heading off to college. I can't float dad indefinitely. Can my mom do a reverse mortgage? Now in this case, because mom and dad are married, it's going to be mom is the borrower and dad's going to be the non-borrowing spouse. He's still a spouse, but he's not the one borrowing. That absolutely works, and that actually makes up a lot of my oldest cohort of borrowers. I've got people in their 60s to early 70s. That's one cohort. They're usually just doing advanced planning. Then I have early 70s all the way up to 80, and a lot of times these people have started drawing down their monies under management. But of course, every time you take monies from under management, you have to pay taxes on it. So it can be an inefficient way to access your wealth. Those people a lot of times do a reverse mortgage and then do start drawing on it slowly. But after people turn 80, a lot of times they're having serious health issues. One may be in a residential care situation, and the other one's just simply running out of money. So those reverse mortgages, a lot of times people will set them up specifically to care for the residential spouse. The other spouse is living in the home, in the community. And if dad passes away, mom continues to live there. So just because one spouse has died doesn't mean the other spouse can't live there. So the back end, when the loan becomes due and payable, is when the last person on title permanently vacates the home, either because they died or because they've sold and moved to Vermont, or because they've both gone into what I'm going to call a nursing home, so a residential care.
My mom and dad have just passed. They have a reverse mortgage. Do I have to, I'm their only child, or say there's 5 of us, it doesn't matter. Do I or we have to now pay that mortgage off before we sell the home? Or what happens if we sell the home and get more for it than the reverse mortgage is owed?
All right, I teach an entire class just on reverse mortgage back end scenarios. So we're going to just take the scenario you've painted here and answer a few questions, and it may be a topic for another day, what happens on the back end. But let's say mom and dad used $30,000 from their reverse mortgage, and let's say for argument's sake their home is worth $1 million, so it's the pickle jar is $1 million big, as it were. Mom and dad have used $30,000, and now they both passed away. What is due? What is due is the payoff on the home loan. What is due is not what they qualified for. Let's say they qualified for $350,000. That's not due. They didn't ever take it out of the house. What's due is the $30,000 they actually used. You can do anything with a reverse mortgage you can do with any other kind of mortgage. Remember, the only difference is the direction of repayment. You and I, certainly I, have a forward mortgage. We're paying it every month. A reverse mortgage isn't paid every month. It's paid on the back end in reverse. So the kids can either repay what's due and keep the home. That does happen in a certain percentage of homes. Or they can sell the home. When the buyers go to settlement, the reverse mortgage, that $30,000 will be paid off. The kids will get the rest. They go on their merry way and then divide it up according to it's designated in the will. Or
in my case, the oldest male gets the most.
There you go. There you go. Oldest male, gets the loot. There. Yeah. It's a rainbow shiny. Yeah, it's a pot of gold.
My sisters wouldn't like that, but
don't tell them you have a YouTube video. Or they can take out a loan and refinance that debt into their own name. Now, when you see somebody taking out a loan to refinance the debt into their own name, a lot of times there's not just $30,000 due, but it'll be somebody, and I've got a case right now, a medical doctor down in Virginia Beach who inherited the home when his mother passed away. And there's about $300,000 due on a beautiful, lovely home right on the beach. And so he's taking out a new loan in his own name, and he's refinancing that debt into his own name, and then he keeps the home. So anything you could do with a traditional mortgage, sell the home, repay the debt and keep the home, or refinance the debt, those same three things hold true. The one thing that you do have to be mindful of is you can't do nothing. This is a mortgage. You can't do nothing and expect the lender to not do anything. You can't go bivouac in the home and think, oh, I've got a free home. No, it's not how any mortgage works. You've got to do something with that mortgage.
So can that child, those children, come to ACM and refinance or get that balance through ACM, or do they need to go through some other kind of lender or loan situation?
Just any other loan they would qualify for. It's exactly the same. They'll have to show that mom's really died. Just the exact same thing they would do with any other mortgage they can do with the back end of a reverse mortgage.
I hope everybody's gotten a lot out of this. We've only skimmed the surface, and that's because I want to make people aware that this product is here. Maybe, Laurie, if I get some feedback, maybe Laurie and I can go into more detail on a couple of other pieces, like that repayment piece, or how to make distributions, or how the bread dough rises.
Right.
Those kind of things. But don't wait for that video. If you want more information on this, Laurie, what's your phone number?
My phone number is 703-477-1183, and you can find me online at reverselady.com.
Reverselady.com.
Reverse Lady. That's how long I've been doing reverse mortgages. Reverselady.com.
So reach out directly to Laurie, or of course you can always reach out to me and I'll put you in touch with Laurie. Gary at novaagent.com, 703-939-0668. And we look forward to seeing you on the next episode of Gary Explains Things.